Hi guys, it's Imran from Options Insight. Those of you who know me will know that I am a professional options trader and have been for over 20 years. I've worked for major investment banks, hedge funds, and now I teach options trading to the masses. In this video, I'm going to showcase a new crypto options exchange that I've started using called Delta Exchange. The great thing about this exchange is that they offer options on altcoins such as Solana and AVAX and many others. Now, for people like me who haven't really got too involved with these alternative layer ones, and I've kind of just stuck to Bitcoin and Ethereum, it's a good opportunity for me to use options to safely gain exposure to some of the upside in these cryptos that have been beaten down pretty bad lately. It allows me to dip my toes in and do what I love to do, which is trade the volatility. Okay, so let's dive into the platform. Okay, so here you can see the platform. The first thing I would note is that all options that you trade on here are cash settled and collateralized in USDT. This is different from some other options exchanges in crypto, which are crypto margined in either BTC or Ethereum. And it's actually easier this way because the option payoffs are less complex, given that your margin is not floating in value, assuming that you're accounting in dollar terms. And so before you can trade, you obviously need to deposit funds into your account. To do that, you would click over here on deposit, and you would select whatever coin it was you wanted to fund the account with. So you can actually fund the account with BTC, with ETH, with XRP. Also, you've got the Delta Exchange token here, or just directly with USDT. You select a network, and it comes up with a deposit address where you can go ahead and send your USDT. Once you've done that and it settles and you've done whatever KYC you need to do, you can start trading. Okay, so let's have a look at the platform in terms of trading and where you can see everything. So I'm going to focus on the options part because that's what I do and that's what I'm here for. And you've got this options tab here, and you can scroll through and see all the various underlyings that are available. So you've got BTC, ETH, Solana, BNB, XRP, Link, AVAX, and Matic. So a decent selection there of quite a few altcoins that you wouldn't normally find on an options exchange. Now, myself, I'm particularly interested in Solana. And the reason I'm interested in Solana is because I haven't really got much exposure to Solana yet. And if I look at the chart on Solana and look at some of the levels that we could maybe bounce to if we did get a bit of a bounce in crypto, I could see us maybe getting to somewhere between 120 or 140 over the next couple of weeks. So that's kind of the scenario that I envisage is quite possible, given that crypto's had this brutal sell-off, and provided we are pretty close to a short-term bottom, that's the sort of upside that I could see us getting to before we would meet a bit of resistance. So that would be my kind of upside target at roughly around the 140 level. Okay. So if we head back to the actual platform, we can have a look at the options that are available. So on Solana, if I then go to this drop down, I see the maturities that are available to trade. And the maturities that you've got are pretty short dated, 26th to 28th of Jan. So those are like a few days out. Then you've got the 4th of February, and then you've got the 11th of February. So kind of the longest dated maturity that we've got available there is around 16 to 17 days. Okay. Now, I personally generally like to trade a little bit further out than that. Just because it allows me to not have to be right so quickly with my market view. It basically buys me some time for my view to play out. And I like that. And I don't mind the fact that the premium of options when you go longer dated costs a bit more, because I prefer to have that time. But beggars can't be choosers. And if I want to buy optionality on Solana, that's kind of the only thing that's available for me right now. So I'm going to kind of gravitate towards that 11th of February expiry, and then start having a look at which call options maybe might make sense for me to get involved with. So obviously, yeah, to get upside exposure, buying some calls is kind of your first basic way you could do that using options, right? What is a call option? Well, a call option is just the right to buy the asset at the strike at expiry. And so if you want to look at what the payoff of the call looks like, we can go to this strategy builder page, which is quite nice. And here I've pre-selected the 11th of February, 110 strike calls. And we can see that the actual payoff or the underlying at expiry becomes that blue dotted line. So anywhere below the strike, which in this case is 110, we would end up losing our premium. And anywhere above, we would start to make money. The premium of that option is around $5.5. So the break even where we'll start to make money at expiry will be $5.5 above the strike, which is 115.5. So if we bought that option and left it till expiry, we would make money above 115.5, and we would lose our premium anywhere below 110. So we'd lose 5.5. And then somewhere in between, we would make some of our money back. So that's what that payoff looks like for the outright call. But when you're thinking about whether you want to buy an outright call or not, you need to consider the break even. You need to say, by that expiry date, the 11th of February, do I anticipate we're going to get above 115? And what conviction do I have? Right? That's really what it boils down to. Do I have a strong conviction that we're going to get there? And how much above that strike do I realistically think we can go? And what kind of risk reward does that give me? So if I thought we were going to get to 140 in 16, 17 days, then that would actually make this call option worth quite a bit of money. Went all the way to 140, this thing would be worth 25 points. And I only spent around 5.5 for it. So I'd be making pretty much 5 times my money on that, basically. Okay. So that's some serious leverage that I can get if I buy a call option, spend 5, and I think it could turn into 25 profit. That's not a bad trade, and that can give me access to some decent P&L. Okay. Now that's if I'm extremely bullish, I've got very strong conviction, and I end up getting that right. Obviously, bear in mind that just buying the option, if the market goes nowhere or lower, you're going to end up losing all that premium. The nice thing about options, though, is they give you this leverage, but they give you it in a safe way. When you buy an option, you know that the most you're going to lose is the premium that you spend. And that's the key here, right? If we can only lose our premium and we can make multiples of that, that is safe leverage. And that's not the same as the kind of leverage you get when you trade futures, because futures, you don't always know how much you can lose, right? And you can get margin called and stopped out on these freak moves that happen in the assets, particularly crypto assets. So they're far more dangerous. The security that you have with options is you're just spending the premium. That's the most you're going to lose if you trade it from the long side and you only buy options. And that's called buying outright options. If that's what you're doing, then you know that you're pretty safe. Okay, so another thing to consider when I'm buying an option is what are the Greeks of that option? So we can go back to the platform and we can go to the trading side and go to options. Okay, so if I go to the options chain here for Solana options, I can see when I pick the correct expiry, I can see the prices of all the options that are available to trade. And right now, this gives me the implied vol, it gives me the price, it gives me the bid offer, and it gives me the size on that bid and offer that I can trade. It also gives me the delta of those options. Now, if I want to see more Greeks, I can hit the Greeks and I can see what the theta is and what the vega is. Now, these are important Greeks to be aware of. If I buy an option, the delta of that option tells me how much exposure that option has to a change in the underlying, which is important to know. But I also need to know, whilst I'm holding that option, what risk am I taking in terms of time decay? How is that option going to lose value through time? And what risk am I taking if implied volatility goes up or down? And that's what the vega and the theta are telling me, right? The theta is telling me if I bought that 110 call that we're looking at, I would be losing 30 cents a day in time decay. And I would also be exposed to 7 cents of implied vol risk per volatility point that the vol moves on that option. Okay, so right now, that option is on a implied volatility of 135. If it went down to 125, I would lose 7 cents times 10 vols, which is 70 cents. And for an option that costs around $5, 70 cents is a decent amount to lose. So those are the sort of considerations that we need to take into account. If we now look at this option on the strategy builder again, we can do this, we can move this time decay here. So you can actually see when you buy the option, it's on that dotted blue line, the option value, and it's through time that time value decays away. And if the underlying doesn't move, you're just going to lose all that value and go to zero. It's quite a nice way of visualizing what that time decay is going to look like. Same story with the implied vol. You can see if the vol goes up, I'm going to make money wherever the market goes. If the vol goes down, I'm going to start to lose money in a similar fashion to if the time was passing away and we were going to expiry. Okay, that's kind of how volatility works. If vol was to just go to zero, it would be as if the option had expired now. Okay, so that's kind of what an outright call option looks like, and those are the considerations when thinking about putting on the trade. Now, me personally, being a trader for 20 odd years has conditioned me not to really want to own outright options when they're on like 100+ vol, right? Generally not the thing that I would naturally be inclined to do. And if there was something else I could do to kind of reduce some of my Vega exposure and my time decay, I would generally tend to do it. So if you want to cheapen your exposure and you want to reduce some of your risk, you might want to consider selling a higher strike call option. So here, if I was to include a sale of maybe say the 130 strike calls in the same expiry, and you can get about 2.7 back for those, that effectively halves the cost of the structure. So if I did that, that would seriously cheapen the cost. It would bring the cost down by half, and I would still have upside in the underlying all the way to 130. So arguably the call spread could end up worth $20, and I would have only spent about $2.7 for it, still giving me pretty nice leverage, but just reducing some of my Greek. So you can see without the sale, I would have a theta bill of $30 a day. If I was to trade, these options in 100 contracts, and my Vega would be $7. If I was to sell that option, that would take my theta down to only $7 a day from originally $30, and my Vega would drop from $7 to only $2. So it really does a very good job of neutralizing my theta and my Vega, such that I still have delta to the market rallying, but I can wait a week and this thing won't really evaporate in value and lose me a lot of money, basically, right? And for me, that's a really nice way, to mitigate the fact that I couldn't go longer dated. And if I'm waiting around for the market to rally and the rally doesn't happen, or we have some more downside first, this has reduced some of my risk and allowed me to have upside exposure, but without losing too much. So that's an alternative thing that you can do. And you can see the call spread payoff. If I do this to highlight it, you can see the call spread payoff similar to the call. The break even is going to be a bit closer because I'm paying less money for it, for the overall structure. And then you can see my P&L gets capped out when we go above 130. So that's what call spread looks like. Now, one final, more risky, more spicy version of this trade for someone like me who's done this for a long time might be to sell an even higher strike and turn this call spread into something that we call a call ladder. Okay. Now, that is, you can see what that looks like when I add this on here. And unlike what I mentioned before, where you have structures that have limited risk exposure when you buy options or you buy just regular spreads, what you can lose. When you do things like ladders that are net short volatility because you're selling more options than you're buying, then you introduce an element of risk, right? You massively change the trade. And if you look at the Greeks, when I add that short call, assuming that I sell the 140 call, you can see that I would now actually earn time decay and I would be short Vega. So to me as a vol trader, being short Vega when the vol's at 140 vol, given that it was maybe 100 vol a week or two ago, that's quite appealing because I think the volatility is too high, and I think the volatility could come down quite a lot, especially if the market recovers. So for me, it's more of it's a multi-dimensional trade where I'm not just thinking about the direction of the market, but I'm thinking direction of the market and what vol will do. I think vol will go down, and I want to be long the market, but I also want to be short the vol. So I would do something like this call ladder. And in the end, if I did this call ladder, I would end up spending, about $1 for it, for the potential of making $20. And I would only really get into trouble if the market broke through, $150, right? Or $149, which would be like a break even for me. That's when this thing, actually, no, tell a lie, it'd be 159, right? It's a pretty far away break even, given that I'm buying the 110, selling the 130, selling the 140. So this thing, in my mind, gives me quite a lot of comfort that this thing needs to rally best part of 50% to get me into any trouble, and it has to do that in 16 days. I mean, don't get me wrong, it's possible, anything's possible in crypto, but I'm pretty sure a 20% bounce, this thing starts to meet some resistance, right? So I feel pretty comfortable with that structure, with that call ladder, and I think that's the type of structure that I would want to trade. And now I'm going to show you exactly how I would go and implement that on the platform. Okay, so we've decided that we want to buy the 11th of February. We want to buy the 110 strike call. We want to sell the 130, and we want to sell the 140. Okay, so we need to, now we can't put that in as a strategy all in one go, so we need to leg into each of the options individually. Okay, so the way you would do that is, you would click on here for the option that you want to buy, which is the 110 strike. You can see here the order book comes up. The offer is 5, the bid is 440. So I can say I want to buy that. Now I don't need to put in a bid that's equal to the offer. I can probably come inside that at something like 4.8. And if let's say I want to buy 100 contracts. And here you can see buy 100 contracts of the Solana, 110 calls, 11th of February expiry. We want to pay 480 for it. And that's going to be 480 USDT of premium that we're going to have to put down. So just checking we've got enough of an available balance for that. And then we place the order. Okay. And that order's gone into the market. And now we can see our bid is there. 480 is in 100 lots. That's our bid. Okay. So that's we're in the market there on that strike. And then we would then go ahead and put offers in the strikes that we want to sell. So for example, this 130 strike, we want to sell 100 of these. We're going to stick an offer in that one. So we're going to sell 2. We're going to sell 100 of these. And you can set your leverage here. So this is to determine how much margin you have to actually put down. So generally, you can adjust this number. I'm going to put this number down to, well, if you put that number to 25 times leverage, then you're going to have to post 500 of USDT. Okay, set the leverage. And I'm going to sell 100 of those for $2 and stick that into the market. And there we go. That's gone into the market, and we can see my offer at $2 in 100 contracts. Okay. So once I get filled in those 2 options, I'm basically going to have a call spread on. Assuming I get filled in those 2 levels, I would have paid 480. I would have sold 2. So that would be a net spend of 2.8. And then once I'm filled there, I can go ahead and put an offer in the 140 calls to get even more premium back and get into that call ladder structure that I want to do. But right now I'm going to be patient and actually let these orders get filled. That's called kind of legging into the trade. I don't need to get into a situation where I sell all of my shorts out and I don't have my long and the market runs away from me. That's a bit risky. So you want to kind of take your time, put your orders in bit by bit, work the orders, and then you end up with the trade and the structure that you wanted and you're comfortable with. Okay. Anyway, that's the structure that I chose to trade. It was a call ladder structure, but whichever structure you choose depends on your views on spot prices, on volatility, on timing, and on risk tolerance. Okay, those are the things that you need to all decide for yourselves. I chose to do a call ladder on Solana because that reflected my view. The nice thing about Delta is I can get decent leverage when I'm selling those options, so I'm not having to post too much margin. And because I'm a professional trader and I know what I'm doing, and I've done short vol trades many times in my life, I'm comfortable doing that. Okay, but just be careful that you know what you're doing so you don't blow up your account and you don't do trades that are too big when you do short vol trades like this, because they can start to run away from you if markets really start to move. Now, nothing I've said in this video should be considered financial advice. It's purely for educational purposes. And on that note, if you want to learn more about options trading and what we do at Options Insight and our training services, then please visit options-insight.com and drop us a line. You can schedule a free 15-minute consultation with our team. You can email us. We'd be happy to hear from you. Anyway, that's the end of this video. That's me showing you guys how to trade call options on Solana on the Delta exchange. Thanks a lot. And I'll see you in the next video where I'll talk about put options.